Time for our first one here on the channel, and that is Palo Alto Networks, ticker symbol PANW. Over the last year, this stock is down about 8.5% year to date, down 13.7%. We'll come over here and we'll look at these Q1 results. We'll look at some of the other industry peers that they're kind of compared against. We'll look at this one in an ETF. Whenever you look at like a new stock, maybe even like a new sector, what I like to do is pull up a sector ETF and look how they're weighting things. Okay, these guys collect a management fee, so they've got to be at least a little bit decent at picking these types of stocks. And so you see where Palo Alto Networks ranks inside of other companies. My opinion, that gives you a little bit of confidence as an investor. We'll come over here and we'll look at these Q1 results. I actually think this is probably a turning point for this company from an operating profit perspective. And we'll look at this one from a technical perspective as well. Hit that like button if you like that we've added Palo Alto Networks to the rotation. What is going on, investors? Hopefully you guys are doing well out there. We've got a $48 billion market cap on this one. And when we come over here and look at these revenues of just $1.56 billion in the most recent quarter, well, they better be growing these revenues lightning quickly. And relatively they are. Over the last year, up nearly 25%, and they beat expectations by about $10 million. Now, we got pretty clear outlook on this company because they have a lot of visibility. They sign these kind of longer term contracts with customers, and so they have visibility really into the entire year. Again, this was Q1 results. We not only got Q2 outlook, which they have plenty of visibility into that, but we got the entire fiscal 2023 outlook as well on this company, and it's going to be important to go through that. For the upcoming Q2, we're expecting revenues between $1.63 billion up to nearly $1.66 billion. That would represent growth between 24 and 26%. When you come over here and look at what analysts were expecting, was a number right at about $1.65 billion. So basically smack dab in the middle of the range. Again, the company has very good visibility into its own revenues, but also analysts as well. Now, when we look at 2023, we're expecting revenues to be between $6.85 billion up to close to $6.9 billion. That would be about 25 to 26% growth on that top line. For the full year, you were looking at about $6.85 billion, again, coming basically kind of actually towards the low end estimate of what Palo Alto is projecting for. Now, they're expecting non-GAAP EPS to be between $3.37 up to $3.44. Wall Street was expecting about $3.17. When we walk through these earnings, you'll see that they're probably churning out a little bit more profit than was expected, but about the amount of revenue that Wall Street was anticipating. Now, when we look at this company's valuation, it's not cheap, okay? It's pretty expensive, certainly from a price to earnings perspective, but even from a price to sales perspective, when you look at other sectors of the market, 7 times forward sales is actually pretty expensive. But what I always encourage you to do is go ahead and pull up kind of a mix of other companies in that sector and see where the market kind of prices otherwise. And we're actually seeing that compared to some of its peers, Palo Alto Networks is actually relatively cheap, or at least in line with the market. Now, that doesn't make a stock in a sector a screaming buy, but what it tells you is that the market puts a premium on these sales versus if you look at like a clothing retailer or certainly fast food or many other stocks out there. 7 times sales is relatively expensive, but in the cybersecurity space, not actually that much. The other thing that I like to do when I'm looking at a new stock is I try to find the largest kind of cybersecurity, in this case, cybersecurity ETF, which is CIBR. This certainly can be an alternative if you want to get into this space, if you want exposure to this space. Instead of investing in CrowdStrike or Palo Alto individually, you can buy this ETF. It's actually relatively equal weight when you look at kind of the top 5 holdings. Even when you stretch it out to kind of the top 10, 15, 20 holdings, there's not a huge gap in terms of its percentage weighting. The top pick is Infosys. That's got a 6.65% weighting. You come down to Palo Alto Networks, not far behind at about 5.44% weighting in this. In fact, it's in the top 5. And in fact, when you're looking at just kind of a pure play cybersecurity, I would actually say this is probably the top pick, since Cisco, Broadcom, and even Infosys have some other business models as well. Now, when we come over here to this financials, this looks like a turning point point to me. Okay, you had that total revenue at $1.563 billion. Again, that was 24%, nearly 25% growth over the previous year, where you were closer to $1.25 billion. Now, in terms of why this company gets a premium valuation, one of those reasons why is you have that strong revenue growth. The other reason why is the other box that it checks is the massive gross margins. Okay, off of $1.56 billion worth of revenue, you had just $461 million worth of costs that gave you a gross profit of $1.1 billion. Now, you do have other expenses here, your operating expenses. And what we often see with these companies is they blow a bunch of money on the operating side of the business and they tend to lose money. Now, in the past, that was the case with Palo Alto. Now we're seeing this company starting to churn out an operating profit. Notice over the last year, their operating expenses didn't go up that much. Last year, you were at about $950 million. They've ticked up a little bit to about $1.1 billion. That means you take this gross profit of about 1.1 and you minus off 1.086 and you churned out a tiny operating profit to the tune of about $15 million. So now you have positive operating income and you flow all the way down to net income. You even have positive net income here as well. They do a ton of adjusting. Things like stock-based compensation gets added back. So you get this adjusted EPS number, which they'll put on the top of their press releases. Also, it looks like analysts are kind of estimating kind of an adjusted number as well. Again, they're stripping out stock-based compensation, litigation charges, amortization. Some of this stuff is non-cash. Some of it is non-related to the business, but is actually a cash charge. You pull down, they have a very, very, very tiny cash flow consolidated statement here. Notice last year, very much improvement on that operating cash flow. So here's your operating cash flows. Just the cash flow generating, operating the business, very strong. I mean, you were at about $588 million. That has more than doubled to $1.2 billion. Again, that number is strong, okay, because of the massive stock-based compensation expense. In fact, they recognized 87 cents per share in stock-based compensation. So that's why you have nearly $1.3 billion worth of positive cash flow off of $1.6 billion worth of revenue. It's very, very impressive. That is also why a stock like this will get a premium valuation to other sectors and other stocks out there. Pull down to the balance sheet. It's about what you'd expect with a company like this. They've got a decent amount of cash. It's not boatloads, but they've got plenty of cash. They've got a book of business. So it's an interesting balance sheet. They've got these accounts receivables. When you pull down to liabilities, they actually recognize deferred revenue on the liability side because they still have to deliver the product and service to this company. So it's recognized as a liability, but then it obviously transfers over into either accounts receivable or into cash eventually for this company. Not necessarily dollar for dollar because there's obviously expenses here, but when you look at the liability side of the business, they have about $12 billion worth of liabilities, but understand that about $3.7 billion is current deferred revenue. They also have long-term deferred revenue at about $3.5 billion. So over $7 billion of quote liabilities is actually just deferred revenue that they're recognized at a later date. Again, when those services are realized, usually they're signing longer term contracts with these companies. They get paid up front and they have to recognize that revenue over a long period of time. That's your financials over at Palo Alto Networks. When you come over here and look at this technical chart, it could go either way. Okay. Now you're making a series of lower highs. You've made some consolidation pattern on the side. You have a lot of support for the stock here at 140. There's a secondary area of support, basically where the stock was today at about 156. In the after hours, it's popped up a little bit up to about $167 per share, but it's now at kind of at a decision point from a technical perspective. It needs to prove that these lower highs will not continue, and so you need the momentum to stay in this stock and really push up at least to the 190 region. Given the visibility that we have, not only up into the Q2, but also the 2023, seems unlikely a little bit to me, but obviously if you get broader strength in these markets, that is certainly possible. I think probably the higher probability outcome is these lower highs continue, you get rejected at this level, and you do some kind of pullback in this stock. The first area of resistance or support is really back here at 155. Lower than that appears to be 140. That's probably where I'd be interested in this one. Now, you've got a small little gap here where if you break this 140, we saw Google do this, we saw Tesla do this more recently. You break through kind of a longer term support on this one, you've got a pretty far way down to go. And so I wouldn't necessarily be aggressive buying this stock at this area. Again, we have very clear visibility into Q2 and into Q3. Every investor knows this. Clearly, this company could sign some longer term contract or something like that really boosts the revenue outlook for this year or upcoming quarters. That's certainly possible, but I believe somewhat unlikely. I think you can slowly drip into this one, or if you want exposure to the space and not have individual stock risk, there are a few ETFs, including this larger one. Again, I'm not affiliated with these guys. I don't care if you buy it or not, but the ticker symbol is CIBR. It's a cybersecurity ETF that is very broadly diversified in a number of names, including ones that have slightly more diversified products mix than Palo Alto does. Hopefully you guys enjoyed today's video. Again, remember to smash that like button if you like this new stock, and we'll keep it in the rotation. Hopefully you guys have a great day out there. Good luck with your investments.